it's Craig Haskell with the Value Hunt Academy. You're listening to another exclusive interview with a leading authority in the opportunistic and value real estate investing space. How many times have you been looking through a pile of deals and just wanted a quick, down, and a dirty analysis to see if a deal made sense to dig deeper? Well, if you're like most, your time is valuable. You need a way to quickly wade through the dogs so that you can spend more time on the good deals. Well, we found the solution for you so that you can quickly assess a deal within 1 minute. We are speaking with Bruce Kirsch, founder of REFM, a leading training and consulting company on financial modeling. Bruce is a spreadsheet maverick who teaches private investors, large company executives, and university students on how to model deals for success. Oh, and he graduated from the Wharton School with an MBA in real estate. Bruce has developed an analysis spreadsheet called the back-of-the-envelope analysis for many types of properties. Bruce walks us through his back-of-the-envelope spreadsheet and shows us how to correctly use it. In this interview, Bruce will tell you where to download his free spreadsheet, explain how to use his quick spreadsheet, show you why the spreadsheet will save you lots of time. And Bruce will also teach you the best way to use his spreadsheet, how to outline things to consider when entering data. And in this interview, Bruce will give you a free tool that you'll use often. If you want to find a quick way to assess your deals and stop wasting time on analyzing dogs, then you need to listen to this short interview with Bruce Kirsch. Bruce gives us the answer to quickly assessing a deal within 1 minute. All right, Bruce, thanks so much for joining us here at the Value Hunt Academy. I'm so excited to get into some really critical stuff, which is deal analysis. And you're an expert in this area of analyzing deals. In fact, your website focuses pretty much on modeling. I wonder if you could kind of give us a background about your website.
Sure. Thank you again, Craig, for having us on. Yes, so the company is called Real Estate Financial Modeling, or REFM for short, and the website is GETREFM.com. And yes, you are absolutely correct. Everything that we do revolves around the nucleus of financial analysis of real estate transactions and partnership structures for real estate investment. And everything that we do is based in Microsoft Excel because it is the most widely used and popular and transparent and powerful tool out there for this type of analysis. And so what we offer is everything from templates, which we're going to talk a little bit more about today, for loading in deal information, transaction information into the template, and then seeing if the deal looks promising or not, given various assumptions. We have educational opportunities in the form of self-study content and live training opportunities, both in person and virtual training, which you can do online from wherever you have your laptop. And we offer consulting services as well, and a certification program for those who want to prove that they have really sharp Excel skills.
So I guess one of the interesting things about your website is it really covers a wide range of help. I mean, you service some of the more advanced guys as well as servicing some of the more the novice guys. I know a lot of members at our Value Hunt Academy range. We have CCI members all the way down to just people getting going. So your website and a lot of the training and products that you have are geared towards pretty much everybody.
Yeah, this is the beauty of learning and investing in yourself in this way is that the principles are the same no matter how large the transaction. It's just that you have some more zeros on the end as you graduate to those larger deals over the course of your career. And so it's really worthwhile to get these principles and these hard technical skills under your belt and master them so that you can proceed with confidence as you move into these larger transactions, and be able to look at them and have clarity with respect to which ones are worth the risk and which are not.
Well, one of the things that we're going to talk about today is a free tool that you have on your website that I recommend everybody go over there and download, and it's a tool that's kind of a back-of-the-envelope analysis, and you have it for different property types. The one we're going to focus on today is the multifamily acquisition model, and I kind of want you to see if you can give us an overview of that spreadsheet.
Sure, I'd be more than happy to. So just to back up for a second, a back-of-the-envelope model is just another name for what some people call a back-of-the-napkin analysis. And basically what it's intended to do is provide a litmus test as to whether a transaction looks promising and attractive or not in about 60 seconds. So in other words, before we go ahead and make the investment of hours of our time and start getting knee-deep in spreadsheets, doing multi-year future projections, let's just take a really quick look to see if the basic economics of the transaction today are attractive. And if they're attractive today, then they could potentially be even more attractive in the future. And so what we do with these models is we limit them such that they are printable to a single letter-sized page, so that it's information that you can just print out and it's digestible and you don't need to spread pages all out on the conference room table. All of the information is contained on a single page. And there are inputs, which we format in a bold blue type, and then outputs, which are either in red or in black. And it basically is a connect-the-dots type of exercise where you're just going to step through the various blue inputs, and all of these are pre-populated such that you can see how the model works. So basically what you do is you take the details and particulars of the transaction that you're considering and simply replace the existing inputs with those that are related to your transaction.
Are there any limitations to using this that you think that maybe doesn't apply?
Well, there's always limitations, and there's always the danger that the values that you are using as inputs are not accurate. Now, nobody can see into the future, so you do need to always take these types of analyses and even more lengthy and in-depth analyses with a grain of salt, because the math is simply carrying out what you've told it to do. But all of that math hinges on various things such as a rent growth rate or an expense growth rate or a lease-up rate, things that you do not know, but you have to estimate in order to get these models to give you an answer.
All right, well, let's jump into this baby and kind of go through it. We've broken it into 4 sections. It's actually a spreadsheet that contains these 4 sections, but let's start with the first section of your model here. Kind of walk us through some of this, maybe line item by line item. I'll ask some questions that might be pertinent.
So what we're looking at, in which you have labeled Section 1, this is the basic property information, and also an assumed purchase price. So we start just by labeling the property. Naturally, we're going to be looking at lots and lots of different opportunities. So we always put the project name or address in there. The date, today's date, is automatically populated. We specify the nature of the asset, how many units, what's the size of the lot, when was it built, and those are really just more informational. The purpose of the analysis is a financial analysis, but nonetheless, it's always good to have a context for the physical nature of the asset and the age of the asset, which will probably tell you something about the condition of the asset. Okay, and so the first section that we have below that basic property information is the acquisition sources of funds, and this basically is defining how are you going to fund the purchase of the property, okay? And the first input is the purchase price, and so naturally there will usually be a asking price on a property, and so you could simply input the asking price if you wish, or you can put in a price somewhat below the asking price and start there. The next piece is going to be a budget that you set aside for renovations. If there is a value-add component to the investment, then you naturally want to include a budget amount for those renovations, whether they're in-unit renovations or at the building level, such as boiler replacement and so on and so forth. The line item below that is simply your transaction costs. We're always going to have transaction costs, and we can't overlook that, so we enter in a percentage, which will then be calculated off of the base amount of the purchase price. That total amount will be our total acquisition cost, against which we will need to estimate the equity or cash investment that will be made and debt or mortgage that will allow us to create an equality between the total acquisition cost and renovation budget together and the total sources of funds from both equity and debt. So the next section concerns the intended hold timeline. Okay, so what we do here is we say, all right, well, how long do I think it will take this property to stabilize? And so we can input a number of months as an estimate. And then after that point of stabilization, how long do I think that I will hold the property? And this will allow a calendar to be generated such that we can, in fact, have an idea as to when we think we'll be exiting the property. Okay, it's always critical to have an exit plan whenever you enter into an investment. And we'll also drive some of the other calculations in the model.
Let me ask you a question, Bruce. Now, these numbers that you have here, you're getting these from actual numbers, probably 12-month trailing numbers from a property. Is that right?
On Section 2, yes. Section 2, those are TTM, or trailing 12 months, just property operating data that is available when the broker lists a property.
Are there any certain guidelines that you use, for example, for some of the areas that are in blue, like the other income or operating expenses?
Well, I mean, it's always good to keep an eye on what the operating margin is, but anything that's in blue, that's a dollar value, that's trailing 12 months actual, okay, this is presumably what the property has actually generated. Now, whether you believe it 100% as it's coming from the broker and or the owner, that's up to you. You always need to exercise your own business judgment as to whether you should give some of these income numbers a haircut or perhaps gross up the expense numbers a little bit. But nonetheless, what we're showing in this particular example is an operating margin for our net operating income of roughly 50%. So something like that is a reasonable operating margin before debt. And if it's significantly lower than that, you're probably not going to like the result at the bottom of the page.
It seems like that what you have right here, the operating expenses seem pretty reasonable, and most operators or most investors that know their marketplace kind of have an idea what expenses might be, unless there's something unusual. It kind of comes down to the gross potential rent, really, on the revenue side. Now, would you recommend using maybe a rent roll or something like that to get more of an accurate gross potential rent?
Well, yeah, anytime you can get a rent roll or the actual leases for an asset, absolutely request it and read through it. Okay, this is all important information, and the leases are what provide the income stream. So it's also good to compare. If you don't have those leases in hand, try to get information on the building next door, for instance, or the building across the street. And if something looks fishy as to just how healthy this particular building looks, maybe there's a good explanation for it, but maybe there's not.
All right, that sounds good. Let's roll on to Section 3.
Okay, so Section 3 is really just a simple exercise of filling in all of the typical line item expenses for operating the property and for paying real estate taxes. So again, all of these numbers are in blue. These are inputs which you're simply going to take from the property operating statement for the trailing 12 months, and you simply plug these in such that they will all total as they total on the PDF document that you get from the broker.
I just want to make a little footnote here because a lot of the numbers that you pull from operating expenses, especially some bigger companies that own properties, they run a lot of expenses through their operations that normally investors will take over but don't really have those expenses, so they kind of need to keep an eye on what is not going to be ordinary, going forward.
Right. Well, I mean, there's typical operating expenses which are going to be deducted from your effective gross income to get you to your net operating income. And then there are those less common one-time or once in a decade type of events such as a boiler replacement or a roof replacement. These are not things that happen every year typically, but as you are insinuating, can make a huge impact on a cash flow over the course of a particular year when that is absolutely critical to do. So you should also make sure that there's a sufficient cushion in your reserves and replacements line, which we do have here as an expense. So that's something that you can be a little more cautious on. It's always better to have cushion than not.
Yeah, and I think some operators actually run their capital expenses through their operating expenses. So when they run their their income expense report, it'll actually show up as an expense when it's really capital. It should be below the line. So I was just trying to point that out to everybody.
That's something that typically people would not want to do if they're marketing a property for sale, because that's going to make the normal operation of the assets look depressed with respect to the operating income. But it is important to understand that different folks will treat these types of things and categorize them differently. And you do need to have a discriminating and a discerning eye when looking at these statements, because they're going to come in all sorts of shapes and forms, and some of them will be in great condition and others will be in less than great condition.
All right, awesome. Let's roll to Section 4, and I've got a couple questions once you get through it.
Yeah, so the last thing that I just wanted to point out for Section 3 was in the right-hand column, you'll see that it's labeled on top a pro forma for year 3. And in Section 2, we actually had a blue input where we had the ability to select what year into the future we wanted to forecast these values for. So we had input a 3, and now what we're seeing here in Section 3 are these numbers grown, by our expense growth rate, which we have also made an assumption for over the course of 3 years from today, the point of purchase. And so Section 4 is going to assume a gross capitalization or gross sale price of the asset using the input of the assumed cap rate, which in this case we said is 8%, applied to that forecasted year's net operating income. So in this case, we are saying that it's going to be based off of the year 3 net operating income. Now, some people will try to sell their assets based off of a future net operating income. So that's something that you could also accommodate for in the model if you wish. So if you truly intend to sell in year 3, but you think you'll be able to price the asset based off of year 4's NOI, then you can simply type in a 4, and your gross sale price will be calculated off of the year 4 values. And naturally, unfortunately, when we go to sell, there are transaction costs that we can't overlook, which are cash costs. So we have an assumption in for selling costs as well. And then we had a loan that we put in place in Section 1, and so we need to also remember that whatever is remaining on the principal of the loan needs to be paid off from those sale proceeds. And then what's left over, the net sales proceeds, comes back to us as the investor.
That's what we like.
That's what we like, exactly. Now, it's important to keep in mind that what we're seeing in the net sales proceeds line after debt is just that amount from sale. That amount is not our total return. It's not our total net cash flow from the property. We've assumed that we have held it for a certain number of years, so naturally we have those interim year cash flows for instance, we had our pro forma year 3, our operating cash flow for year 3 was $86,000 for the year. Okay, and so if we've had roughly $80,000 per year for 3 years, we can, in our heads, put that additional $240,000 on top of our net sales proceeds amount from the actual disposition of the asset.
So if we go back to Section 2, the last line says cash-on-cash return. It says it's basically a 10.89% return based on year 3 numbers and the selling price that we got.
Correct. So the cash-on-cash return is simply dividing the operating cash flow, which is going to be your NOI after you have fulfilled all your debt service requirements, divided by the total equity, cash equity that you put into the asset over time.
Now, I wanted to ask one question about the cap rate. Any guidelines, any rule of thumb that you use or you've seen used to forecast, let's say, 3 years out on a cap rate?
Well, unfortunately, I don't have a crystal ball. Typically, though, safer to assume that over time, as the asset ages, the cap rate is going to expand, meaning the cash flow stream on that asset is going to become slightly less valuable than, let's say, a brand new asset in the same neighborhood. So if we started out at around a 10 cap rate, then we might want to assume something higher than a 10. However, the cap rate when you purchase the asset is just mathematically based on the purchase price and the NOI in place at that time. So if you get a really good purchase price for whatever reason, let's say the seller is distressed in some way, and you get a really good purchase price, then your cap rate might be really high, okay, and prevail. Let's say you had a 12 or a 14% cap rate going in, okay, and just because 3 years passed doesn't mean that you have to then forecast, well, it has to be higher than what I got. You need to look to the market and other transactions, comparable sales, to see the cap rates at which those other properties traded, and that's typically where your property will trade, with certain adjustments made for qualitative factors, because no two properties are alike.
So let's say you've downloaded this spreadsheet and you're ready to use it, and it's something you've used regularly. How long does it typically take to go through this back-of-the-envelope analysis?
This back-of-the-envelope analysis should take around 60 seconds. Once you have the property out, and that's the beauty of it, is you can weed out the bad deals very quickly, so you can spend your time and energy on the good deals. As we all know, one of the hardest things is figuring out where we should spend our time and energy. And so using this free tool is a godsend, because it allows you to just throw things out immediately that don't look attractive whatsoever, and then zero in on the things that do look like they have some promise.
Yeah, it seems like you could really use this thing up front early in the process when you're just out looking at deals, and you have at least some basic numbers before you spend too much time. You can just plug the numbers into this spreadsheet here. Exactly.
Yeah, it's very straightforward. We even provide the ability to not have to enter in every single expense line item. If you want, you can just do a single input for all the expenses. So, you can reduce the number of total inputs in this thing from, let's say, 30 to more like 20s. And it's what we call plug and chug. But as we need to always keep in mind, it's garbage in, garbage out with any sort of financial model. So if your assumptions are way off, then they're going to produce a result that's way off. So you do need to think very carefully and exercise your own business judgment on the values that you input into the spreadsheet. They're all very impactful. So you can't be too casual, and you can't be careless about it, because at the end of the day, it's going to be your money going in and hopefully some money coming back to you as well.
Well, let me ask you about some of the assumptions. This is kind of a global look at, what's going on in the marketplace. For example, let's say rent increases. From what you've seen in your experience, typically, how are people underwriting rent growth in today's marketplace?
Well, the apartment market right now is quite strong in a lot of the major markets, and especially here in the Mid-Atlantic and Washington, D.C. in particular. But generally speaking, the income should, at the very least, keep pace with the Consumer Price Index, the CPI. So, if you are a renter, just take a look at your own rent. If you have been in the same building for at least 2 years, and just do the simple math to see, well, how did my rent grow year over year? And you can use that as a benchmark, assuming that you live in a building that's managed and operated by sort of an average landlord of average sophistication, and you're in an average part of town. If you're in a part of town where things are developing and it's becoming a very hot place to be, then you might want to put in a little bit of a more aggressive rent growth rate, because it just takes a lot of time for new supply to be brought online. And if a neighborhood's becoming really white hot, then there's naturally going to be a rising up of the rents, because everyone wants to be there, and the stock is what it is.
Well, I really encourage everybody to get this spreadsheet and or the other spreadsheets that you have for different product types. How do they get the spreadsheet? Where do they go to get the spreadsheet?
So it's very simple. They go to the website, getrefm.com, and on the top there is a navigation bar, and one of the elements is called Free Tools. And if you click on Free Tools, it'll take you directly to the page, and they're all right there in front of you, and you can simply scroll down and choose one or more than one, and you put them in your cart and you check out. It takes around 30 seconds, and it's an instantaneous download, and it's yours to keep. And you can put it on multiple machines and create various versions of it for property A, property B, and so on and so forth. And it's just a great little tool to have to, again, allow you to work a little bit faster and smarter instead of working harder.
Yeah, and when you put it in your cart, it's actually as a zero price, so it's free for those that are trying to download it right now. And I'm noticing you've got the hotels, you got mixed use, you got condominiums, industrial, office, apartments, self-storage, multi-tenant buildings. You got just about everything there. So
we really do. And incidentally, for those who are interested in learning about a new asset type, these back-of-the-envelope models essentially serve as a checklist for all of the important data points that you need to be able to understand in order to invest responsibly in these various asset types. So just from a pure educational perspective, if you don't know anything about hotels, for instance, and you wanted to buy a hotel, you can just download this model, and you basically have a one-page checklist. So these are all the things I need to know about this hotel, and these are all the data points I need to get from the broker. It's a terrific way to stay organized.
Well, awesome, Bruce. I appreciate it. It gave us lots of great information, and gosh, I'm really excited about this spreadsheet, and I hope everybody downloads it.
Well, great. Thank you so much, Craig, and wish everybody the best of luck in their real estate pursuits, and we're happy to be able to help.
I hope you enjoyed this interview. For more information on Bruce Kirsch and to get his free spreadsheet, visit his website at www.getrefm.com or email him at bkirsch@getrefm.com. For either questions, comments, or ideas, please email me at craig@valuehuntacademy.com.